Have you ever wondered why XRP, one of the most talked about digital assets in the world, has been stuck in the shadows while other cryptocurrencies explode in value? On September 18th, XRP ETFs officially went live, a milestone many thought would finally ignite a massive price breakout. But here we are. XRP's price remains stuck, barely moving while hype fades. So why is XRP's value still being suppressed, even with this groundbreaking news? Today, we'll break down who benefits from keeping XRP's price low, and why that might actually set the stage for one of the biggest moves in crypto history. To understand this, let's set the stage. XRP is a digital asset designed for one purpose: to move money across borders instantly and cheaply. Its utility makes it a direct competitor to SWIFT, correspondent banking, and even certain stablecoins. With the launch of XRP-based exchange-traded funds on September 18th, institutions now have a regulated, Wall Street-approved way to gain exposure to XRP. Normally, ETFs signal legitimacy and bring inflows. Just look at what Bitcoin and Ethereum ETFs have done for their ecosystems. So why didn't XRP's price react the same way? This is where suppression comes in. Despite ETFs going live, XRP is still battling three major forces. 1. Regulatory overhang. Yes, Ripple scored partial wins in its SEC case, but uncertainty still lingers. Regulators move slowly, and that cloud keeps many institutions from openly jumping in. 2. Exchange accessibility. In the US, XRP is still absent from several major trading platforms. Limited liquidity equals limited price discovery, no matter how much positive news we get. 3. Market manipulation. Large holders, market makers, and even hedge funds can suppress price by cycling sell pressure, ensuring accumulation at lower levels before any real breakout. Now let's talk about who actually benefits from this situation. Traditional banks. Every day XRP doesn't explode is another day banks get to milk the existing SWIFT and correspondent banking system for billions in transaction fees. They profit from the status quo. Institutional accumulators, ETFs, are open, but price stagnation means institutions can slowly accumulate XRP exposure without triggering retail FOMO. Suppressed price equals cheaper entry for big money. Competing crypto assets. Bitcoin and Ethereum continue to enjoy the spotlight. Wall Street has already poured billions into their ETFs, and they benefit from XRP staying sidelined as the underdog. Regulators and central banks. A low price allows governments and central banks to continue testing XRP quietly in cross-border settlement and CBDC pilots without sparking massive speculation or public pressure. So how is the price actually kept down even after ETF approval? Low liquidity listings. By limiting XRP's presence on top exchanges, daily volume is capped, keeping price momentum muted. Whale cycles. Coordinated dumps at resistance levels discourage retail buyers and reset the chart. Media silence. Notice how little mainstream coverage the XRP ETF launch received compared to Bitcoin ETFs? Narrative control shapes perception, which shapes demand. Regulatory drag. Every headline about unresolved legal risk is another excuse for institutions to wait before fully deploying capital. But here's the flip side. Suppression can only last so long. When regulatory clarity is final and ETFs have accumulated enough supply, the spring eventually uncoils. If XRP truly gains wide adoption in cross-border settlement, even capturing a fraction of SWIFT's $7 trillion a day network, the current price will look laughably small in hindsight. So while many are frustrated that XRP didn't moon after its ETF launch, remember this: the price may be suppressed now, but it's not by accident, it's by design. And in the long term, the ones holding through the fog could be the ones holding the keys to the future of finance.